Welcome, everybody. I'm Joseph Wagner, your host, and this is this week's edition of the Bitcoin Minute, where we recap last week's price action as well as try to forecast what we can expect this week and beyond. Last time we spoke, Bitcoin was experiencing a pretty decent gain on the day, and that all ended when the FOMC meeting began and concluded. And in that meeting, Chairman Powell reiterated the fact that he believes March is way too soon for rate cuts. It didn't just put an end for the short term to the rally in Bitcoin, it also stopped the rally in Solana, as well as U.S. equities, such as the NASDAQ. All of these experienced drops on Tuesday and Wednesday, coinciding with the FOMC meeting. And the US dollar, interestingly enough, didn't escape its price range during the FOMC meeting or its conclusion. It took longer for traders to actually digest this information, and the gap higher today in the US dollar index puts the US dollar clearly out of its recent range, and now it is trading at 104.498. Last night's 60 Minutes interview with Chairman Powell, where he reiterated that rate cuts were probably not going to happen in March. So we are once again trading in a sideways manner in Bitcoin, and really that's been the overall characteristic of not just the last week, but really the last month. Let's look at a weekly chart here. As you can see, the price is now above 42,000, and that was about the average price for the last couple of months. The only thing that has changed, however, is the narrowing of the range. So, as I said last week, I foresee sideways action that will, in the next 3 weeks, have a break to the downside before the halving narrative fully kicks in and we see a rally, which I believe will take us to new all-time highs by summer of 2024. Now, what are some technical indicators that might agree with that assumption? Once again, let's look to our Ichimoku Cloud, which, by the way, for those of you who don't know, Ichimoku Cloud is one of the few forward leading indicators that a technical analyst has at their disposal. Now, the default settings of Ichimoku Cloud, if you were to put one onto your chart, would look something like this. And as you can see, this is a lot more confusing than the way I have it set up. It is supposed to allow a trader to simply look at a chart with this one indicator. The trader should be able to get a clear picture of the strength or the possibility of a reversal of the current trend. That's why Ichimoku translates to one look, meaning the trader should only need to take one look at the chart and understand the trend strength. So let's cover some of the various lines that the Ichimoku Cloud includes. This blue line, the conversion line. To get our conversion line, we take the highest trading price of the last 9 sessions, the lowest trading price of the last 9 sessions, add them together and divide by 2. The second line used in the Ichimoku Cloud is the baseline. And to get our baseline, we do a similar equation, except instead of using 9 periods, we go back and use 26 periods. So we take the 26 session high, the 26 session low, add them together and divide it by 2, and that's how we get our baseline. Now, to get our leading span A and leading span B, which form the bottom and top edges of our cloud formation, for our leading span A, all we need to do is add our baseline and our conversion line numbers, divide by 2, and then take that number and plot it 26 sessions ahead. For our leading span B, we simply take the highest high and the lowest low over the past 52 sessions, divide it by 2, plot that 26 sessions ahead as well. The lagging span, which is in green on this chart, is simply the current period's closing price plotted 26 sessions back on the chart. This can all be a bit much. What this indicator is supposed to do is simply provide an insight to the strength of the trend and possible reversal points in a trend. Put simply, when pricing is above the clouds, the trend is strong, whether it's bullish or bearish. When pricing is below the cloud formation, it suggests that the current trend is weak. Again, whether it's to the upside or the downside. When the price is inside of the clouds formation, like we've had for the past 2.5, 3 weeks, that is an indication of a possible pivot or reversal of trend. And in our case, we were in an uptrend. So this is signaling a possible pivot to a downward trend. For me, that's why I simply like to include the cloud formations and leave all the other lines out of the picture to give us a much more easily digestible picture of strength of our trend. And let's see what some other indicators are saying. For moving averages, we have just moved below the 50-day moving average a few days ago and have remained there. We have still held on to the 20-day exponential moving average, which is a good sign for the bulls, at least for now. Now, looking at some other indicators, such as MACD, it's showing that the bullish sentiment is waning. If we look at the relative strength index, it's showing that it is pretty much firmly neutral, meaning that it's neither overbought nor oversold. So, what is my prediction for this week? I see us having a price ceiling of $43,000. I do not believe we will crack above that. If we do, then my forecast is invalidated. I see us moving below the 20-day exponential moving average. And if not this week, then by latest next week sometime, we will head lower. I believe the final resting point before we return to a bullish mode can be anywhere from $28,000 to $30,000. We will definitely have a pit stop at $40,000, which coincides with the 100-day moving average. So all things being equal, my prediction for this week is a retest or visit to $40,000.